Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:06 a.m. Central Time, and I'm recording this in preparation for the market day of May the 28th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's dive in to see what happened in the overnight, and there was some fireworks last night. In terms of China, look at China down 6.5%. I can't tell you why. I just see that it has happened. Hong Kong down 2.23%. So the Asian markets got hammered last night. In terms of Japan, so it wasn't all about Asia. It seemed to be connected to China. You had Japan up about 0.4%, Germany down about 0.25%, United Kingdom up marginally. So very mixed signals coming from the overseas markets. Our own markets don't seem to be paying any attention to it. They're all just below scratch across all four broad market indices. Crude oil up about 0.25%. The Euro up about 0.39%, bonds essentially scratch, and gold just above scratch. In terms of macroeconomic reports, you have for today the typical Thursday stuff. You have nat gas, you have the weekly unemployment claims, and you have crude oil inventories. That's not normal. Crude oil inventories at a different time and a different date. So take note of that if you are a crude oil trader. In terms of tomorrow, got G7 meetings, Chicago PMI, and University of Michigan consumer sentiment. So that makes our list for tomorrow. So there are definitely some more stuff for the rest of the week in terms of macroeconomic reports that directly affect our trading here in the United States. In terms of volatility, obviously yesterday, big rebound day, basically recaptured everything that had been lost the day prior. But you see, like on the S&P, down 2 standard deviations 2 days ago, and then up 1 plus almost 2 standard deviations on the S&P yesterday. Also had standard deviation moves put in by the Russell and the NASDAQ. NASDAQ powered by the Broadcom acquisition news, so that had a big effect on a number of the semiconductors across that industry group. You have short-term VIX ebbed a little bit, 11.93. IV percentiles 18, 6, 16, 30, all still very, very low. Not a lot of fear in this market, even when we had that big down day. These numbers, did not denote any kind of fear had come into the marketplace. Let's see here. In terms of our regular daily report, not a lot of changes here. This is a pretty solid report here. Again, not a lot of fear. We have our cautionary views, and certainly the fact that we bounce back into the range, just isn't great news. But we certainly recaptured much of that yesterday, and kind of cleared the prior range. So what do we make of this? I mean, if you take a look at this, we spent so many times, so many failures coming to the top of the range and then immediately being rejected time and time again, about 7 times during this multiple week process. We finally break out. We get a kind of confirmation push, and but then we kind of stall and spend several days going into the holiday on light volume, tickling new highs, tickling new high closes. But then as soon as everybody comes back after the holiday, abject failure, which is then met by a total recovery the next day practically. I mean, we practically got back. In terms of intraday, we surpassed the activity coming from the holiday, but in terms of close, practically recovered 80-90% of the drop from the previous day. So guess you call this a bullish harami. It's not the typical pattern I see. I mean, it's inside the low, inside the high, very bullish candle, big body. So certainly was a very bullish action, and it kind of put us back up here, I guess we'd say above the top of the prior range, and yet it's really hard to take much confidence from this activity. So lots of things coming back and forth. Part of this comes back to what's going on with some of the other indices. Obviously, the Russell also had a big recovery day, was even more bullish on a relative sense in terms of, it did more than just recapture the prior day's move, and yet it's got so much more room to catch up. You have the NASDAQ, of course, powered by the news, and it's right up here near the all-time high. I guess that's probably an all-time high close on the NASDAQ, powered by Broadcom's news. And then, of course, the Dow Jones, much like the Russell, a little bit weaker, and certainly did not recover anywhere near 80 or 90% of the prior day's action. This is all against the backdrop of what's going on with transportation. And we've had the big breakdown of transportation. Now, there was a over 1% move up in transportation yesterday. But at the same time, until this actually regains some of these moving averages, this looks to be a breakdown. And with the breakdown of transportations, the relative weakness of the Russell, and it's hard to put too much into what's going on here. So you've got to be really, really nimble and very careful in a market environment like this where there's so many mixed signals, or you're going to find that you're going to lose a lot of your hard-fought capital. But bottom line, we are higher highs, higher lows. We are confirmed uptrend. We are a GMI index of a 6 out of 6 that went up a notch yesterday. We have an intermediate term market posture that is very bullish, but again, kind of mixed signals. You have the S&P held on to the very bullish stance. NASDAQ also very bullish, both of these above an 80, and yet the Dow dipped into bearish and the Russell into bearish. So very much mixed signals in terms of the market posture. Now, overall, we call this very bullish because we're dominated by the S&P 500, and that's where the signal comes from. But when you roll all this together along with other warning signals, we still remain throughout all this with the threshold level 0+ hedge warning status, normal with cautionary aspects. You see some of those warnings that were volatility based came off yesterday. We have relatively low distribution count, not a lot of worries there. We do have that daily squeeze on the VIX present. We do have not a lot of new highs yesterday for the New York Stock Exchange. In fact, there were a lot more new lows than there were new highs. If this had been over 300, we would have considered that a warning. You have 3 of the 5 intermarket risk aversion indicators are flagging risk off. So a lot of just continuing mixed signals coming into this marketplace. Option income strategies, VIX is inside the acceptable window. Consider the potential for increased volatility. Certainly picking and choosing what you trade in. Trading in the SPX is probably, for example, more predictable right now than, say, the NASDAQ, because the NASDAQ being pushed around by a handful of companies, 5 or 6 companies dominate that exchange, and you'd have to be a bit more bullish on the NASDAQ, and yet you have broad market that's very, very mixed. So a lot of crosswinds could be coming into doing option income strategies in some of these indexes. Cover call strategies, cautiously bullish, 3-to-2 distribution between in the money and out of the money strikes. Put selling, conditions are acceptable, but consider put credit spreads for defined risks and scaling into positions until the market has confirmed a breakout from the trading range. In terms of sector market postures, it's like a Christmas tree, every color in the rainbow here, and that is absolutely a reflection that we've got a lot of cross currents going. But note, healthcare, financials, technology, of course technology being driven by that news event yesterday, are perhaps the strongest sectors of the moment. And then against that, transportation and energy, the weakest sectors of the moment. But this is flip-flopping back and forth so fast. Nothing is in a normal rotation to where something takes dominance and runs for weeks to months. These have been coming and going about as fast as you can flip a coin. Sector market posture, percent change. Obviously, big day yesterday. Energy was down for the only sector that was down. Also, utilities, not exactly super strong. But on the other side, information technology, driven by that news about Broadcom again, very much up and helped the entire sector. It wasn't just Broadcom with the news that was pushed up, but many of the other companies like SWKS and others that are in that space were also driven higher. Healthcare also did very well yesterday, and financials as well. So in terms of your watch list, take a good close look at some of those retail names: internet, healthcare, biotech, railroads, transportation. Round out the top of the list according to the shadow trader weighting. Obviously, we've been talking about transportation. There's been components in here that are certainly getting hammered in the short term and maybe breaking down. I think that's enough for today. As always, if you appreciate what you're seeing here, if it's helpful to your trading, we appreciate you liking us on YouTube. More information about our activities every day available on the website. Disclaimers as always. Hit the pause button if you need more time to review. And we'll see you back here before the market opens on our market preview tomorrow morning. Thank you.